And the topic for our webinar today is a look at one of our core principles around investing that governs which types of investments we use for clients. And as our clients, you know that we're not actively calling you up for hot stock tips or constantly trading in your accounts. So hopefully you're comfortable with this general philosophy already, but every now and then we like to review this and provide those that are interested a little deeper look at the whys of what we do. And so for our webinar, we're covering three main topics of asset allocation. And we're going to go in this order here. We'll start by looking at what investments you should own. This is diversification. Once we establish that, we'll look at how many options you have to own those different investments and the best ways to do that. And then finally, we'll look at the impacts of the costs of investing and the effect that that can have on your performance. And so just to begin, maybe let's start with a very basic goal that everyone kind of enters in the retirement savings or investing world with. And that's just that we want our money to grow. We're saving now for money in the future. And we know, or we've heard, that investing in the stock market is a good way to do that, right? And that's great, it is, but investing in stocks can mean a lot of different things. And so where do you start? And if you do some Googling or follow some advertising that you'll see, you're going to be quickly enticed with the prospect of buying individual stocks, right? So here's Robinhood's website, for example, right on the homepage, invest in Nike and Tesla and Apple. This goes on. E-Trade is the same way, right on the homepage here, highlighting a few individual stocks. Why would you not want to own these top 5 dividend stocks, right? Same thing with Charles Schwab, Merrill Lynch, or Bank of America. You can see here, quickly identify your next big idea, or simplify your search for the right stock, right? And so this is how a lot of people get started with investing, or at least saving outside of a workplace retirement plan. New investors are definitely pushed into individual stocks, and the idea of finding, that one right stock is all you need. And so I think a lot of the appeal of doing this also comes because of stories or headlines like these here. Investing in stocks is really easy, and everyone wants to invest and dreams about, finding that one stock that's the next Apple or the next Amazon and hitting it big with your investment, right? And so is this really the best way to invest, though? You search, find a few individual stocks, hope you found the next Apple, and hold on. And then if so, even if, how many stocks should you buy? What does it take to build a good investment portfolio? And there's actually a lot of research on this. There's one really interesting paper in particular with the title, "Do Stocks Outperform Treasury Bills?" And it's a very comprehensive study based on about 90 years of stock market history and looking back at the performance of more than 25,000 stocks that traded over that time period. And what they find is that owning a select number of individual stocks more often than not leads to results much worse than what we think of as that average stock market return. And so I pulled a few quotes from this paper to highlight and just very briefly touch on. First, the paper finds 4% of companies accounted for all the net worth creation in the stock market. A very select number of companies are responsible for that return that we think of as the stock market return. And even if you buy individual stocks and own hundreds or even thousands of them, if you miss those very select few, that 4% that go on to perform well, your performance will very rapidly become similar to the return you would have received if you instead just bought a short-term treasury bond instead, which of course, is much less risky than the stock market, no volatility. And then going further, less than half of the stocks that existed in this 90-year period had lifetime returns greater than the returns you would have received if you just invested in a 1-month treasury bill. So if you bought a stock during this time period, it's more likely you got a return lower than if you just had purchased a 1-month treasury bill. And then lastly, I thought this quote was good just to keep in your mind as you are thinking about the benefit of investing in individual stocks. The single most frequent outcome observed in this 90-year history for an individual common stock is a loss of 100%. And so what's the takeaway from these points from this paper? Owning anything less than the entire stock market, right, very quickly puts you at risk of significantly underperforming the general stock market. You're going to end up taking a lot more risk for an investment that at best just doesn't do any better return than a 1-month treasury bill. Everyone dreams of finding the next Apple, the next Amazon, and that is very much the unlikely scenario. It's much more common for you to see a loss, and the most frequent outcome is a loss of 100%. And this study is not the only one out there that comes to this kind of conclusion. Here's a chart from a separate JP Morgan research paper that looks at a data set just since 1980 and just of the Russell 3000 index. This is an index of 3,000 public companies in the United States. And so a little bit smaller of a data set than the previous paper, but still very thorough and representative of the US stock market. And they find the same general ideas. Here's a few quotes. The median return of an individual stock over this period is 54% less than the general index. In other words, the median stock significantly underperforms the general stock market, which is propped up by those very few, very rare extreme winners, is what JP Morgan calls them in their paper. 66% or 2/3 of all excess returns versus the Russell 3000 were negative. This just means, again, most individual stocks underperform their bench or their index. And 40% of stocks had negative absolute returns. And so not just underperforming the general market, but actually losing money for their investors. Now, you can look at these two research papers and come to the conclusion that, if you just pick the best stocks, you could outperform the market and perhaps very significantly. I guess that's technically true, but it's also sort of like saying you can get rich by playing the lottery or playing slot machines at the casino. It's right, but you have to get lucky. And the numbers say you are much more likely to lose money instead. We read this data from these couple papers and some others that are out there and say, okay, it's not worth it for us to try to pick stocks in clients' accounts, right? We should own as many of the stocks as we can, get access to as much of the market as we reasonably can to make sure that we get exposure to those 4% of stocks or whatever small amount of extreme winners that are out there so that you can capture the returns of the stock market. Let's see. So now I guess our philosophy that we started with, right, invest in stocks, has become invest in a lot of stocks. But how do we go about doing that? This is where mutual funds and more recently ETFs or exchange traded funds have kind of entered the picture. And this need for diversification was figured out a long time ago. And the mutual fund was invented quite a while ago. And so here, this is looking at a fund managed by a Capital Group or American Funds that has been around since 1934. You can still buy this fund today. It has 90 years of history almost. And so what this does, what any basic idea of a mutual fund is to make it very easy for you to invest in a large number of stocks. And so you can see here, this fund owns about 190 stocks. And so one click of a button, you can own a couple hundred stocks. Very easy, right? But how do you find, this is just one example of a mutual fund. How do you go about finding the best mutual fund for you? What are the difference in all of the funds that are available? And this is actually more difficult than it sounds because there's more than 7,000 mutual funds available for US investors today, which ironically is more than the number of individual stocks that are listed. And so trying to narrow down the investment universe is very hard. And if you use Google to help you, you'll be presented with a lot of ads or expensive services to access, their ratings of all these funds. And searches like this are going to bring up results from what are called active funds. These are exciting investments that are out there that make headlines or are frequently written about because they're led by some star fund manager or they performed very well last year. So they received a 5-star rating from somebody, or maybe the fund company just spends a lot of money on ads. And what does an active fund mean exactly? And what's the alternative to these active funds? On the left image here is the fund description of an active S&P 500 fund. And so this fund benchmarks itself against the S&P 500, but they have a very active approach. And you can see here that they are seeking to outperform the benchmark by identifying 30 to 60 companies and just investing in that, right? So there's going to be several hundred of the 500 stocks in the S&P 500 that they do not own. Compare that to, on the other end of the spectrum, an S&P 500 index fund. And so an example shown here on the bottom right is Vanguard's S&P 500 fund. And notice right away the difference in the fund description. It seeks to track the performance of the S&P 500. Vanguard's not trying to pick winners or losers. It just simply owns all 500 companies to ensure that the fund gets the return of the market. And so which one of these funds is right for you, right? This is two very different approaches to investing. And we know from our first topic of diversification that we want to own a lot of stocks. And one problem with active funds in general is that they hold only a select number of stocks. This is another research paper here that studied the couple thousand active funds that are out there and found that the median number of stocks held by an active mutual fund is 65. And so add this fact to the findings of that first paper that we looked at about how very few number of stocks produce the actual return of the stock market. And we can put these two findings together and say that if we only hold a few stocks, we are greatly reducing the likelihood that we're going to own one of those 4% of stocks that produce those really great long-term returns. This is going to make it more likely that these active funds underperform the general market. And what do you know? The data actually shows this. This is a table from a report by Dow Jones from an annual study they do each year called the SPIVA, or S&P Indices Indices versus Active Report. They look at the percentage of active funds that underperform their benchmarks over different time periods. And so just for example, since we were talking about the S&P 500 earlier, let's look at the second row of this table highlighted here for large cap funds that are benchmarked to the S&P 500 index. And so 1 year performance, this was in 2022, 51.08% of funds underperformed the S&P 500. So right at about half of fund managers beat the market, pretty much a coin flip. But over longer periods of time, for example, 5 years, 86% of funds underperformed the benchmark. Over the longest time frame, so 20 years now, nearly 95% of active funds have underperformed the S&P 500 or the benchmark in this case. And so if you want to invest in a fund today, you have to look at this data and at the very least understand that you're making a bet on a very unlikely event if you are investing in an active fund and expecting it to outperform the market. Lastly, you can see that these numbers stand for every index that S&P tracks, whether it's small companies or real estate funds, growth funds, value funds, it doesn't really matter. As you look down that right-hand column, the vast majority of funds in every category underperform their index over these longer time periods that all of us will be investing over. And Dow Jones is not the only one that has found this type of result. This data is from Morningstar. This looks at many more indices, so not just indices that are managed by S&P, and then also a lot of different types of categories. So say emerging markets or foreign stocks, bonds, and those types of investments. What might be confusing at first glance is that these numbers are now showing success rates. So before it was showing underperformance rates. So just for example, that 10.4% number in that far right column on the top right there, this would be equivalent to an 89.6% underperformance rate if we were using the same method of reporting that Dow Jones did. But Morningstar's data shows a very similar story. The vast majority of funds underperform their benchmarks over longer periods of time. And if you really want to invest in an active fund, you have to go in at the very least knowing that the numbers are against you in outperforming the market. And so we look at this data that concentrated stock positions are very likely to underperform, and active funds are therefore likely to underperform for the same reason. This leads us to index funds. Unlike actively managed funds, these are funds that just simply own every stock or bond in the index, not a select amount, not picking and choosing. So these funds satisfy our desire to be diversified as possible and own the whole market. And since these funds are simply following an index, they are not constantly trading and buying and selling all the time. This is where the term passive comes in that you hear a lot. And passive can be measured by a metric just known as the fund's turnover rate. This tells us the amount of the fund's assets that changed investments over the course of a year. And so just shown here at the bottom for this Vanguard fund has a 3.4% turnover rate, which just means a very small portion of the fund is different compared to a year ago. As an extreme, 100% turnover rate would mean that all investments in the fund that the fund had last year are now gone and replaced with new holdings. Active funds tend to, on average, have a turnover rate 50% or higher. So these passive index funds get you exposure to the whole index, making it much more likely you're going to own one of those 4% or the very select number of stocks that do really well. And therefore, your portfolio gets those stock market returns that we are all looking for. And so this is great. So now our statement is not just invest in stocks. It's not just invest in a lot of stocks, but investing in passively managed index stock funds. And there's one more level of detail that we're going to add to this, though, and that's fees. Because even if you select a passively managed index fund to invest in, you're still exposing yourself to one other variable that can cost you significantly over time and reduce your investments. First, let's look at these two funds as an example. On the left is a fund by a company called Ridex. It's their S&P 500 index mutual fund. On the right side is Spider's S&P 500 ETF. This is actually the very first ETF ever launched. Just for a fun fact, I guess it's a famous fund if there is such a thing. So it's commonly just referred to as its ticker symbol SPY. And so these funds have very similar names that would lead you to conclude that they are the same. The descriptions of the funds are just about identical. The top holdings of the funds are the exact same as well. So, you could look at this and say, is there any reason one of these funds is going to be better than the other? And the answer is overwhelmingly yes, because these funds charge significantly different fees shown here. And so Fund fees are known as expense ratios. They're always listed in percentage terms. And so you can see here that the RIDEX fund charges 2.31%, while SPY charges 0.095%. Now, every fund's going to have some kind of fee, and sometimes it might make sense to pay a little more for a different type of investment. For example, emerging market funds are always going to have a little bit higher fee because it's expensive to manage a portfolio of small companies in non-developed countries. But when two funds are doing the exact same thing, like two S&P 500 index funds, if you see a difference in fees like this, run to the lower fee option. And why do I say that? Well, remember, these funds are investing you in the same thing. If the only difference is the fee, a higher fee is going to reduce your performance. And so shown here is a performance chart of these two funds over the last 5 years. And as you would expect, the higher fee fund here, shown in purple, that RIDEX fund, trails pretty significantly. And so why is that? That 2% higher fee means you have 2% less returns each year. And you might expect then that over a 5-year period, you see something like a 10% performance difference, right? Just 2% times 5 years. But there's compounding on that fee difference too. And so that ends up leading to about a 20% difference in performance over the prior 5 years. And then this gap just gets more and more pronounced as we look at longer and longer time frames. So here's the same two funds, but looking at more than 15 years of performance data. And so now we're looking at more than 150% difference in total performance over this time period, which I think is pretty incredible. Two funds that at first glance should do the exact same thing have dramatically different returns. And if it helps just to make this point, sometimes percentages can be tough to think about. Here's that same chart showing the growth of $100,000 over that same time frame. And that fee difference means $110,000 in difference in ending account value. And so that leaves us with this, our core investment philosophy for why you should invest in low-cost, passively managed index stock funds to get exposure to the whole market at as low of a cost as possible. And so what is the downside to the strategy? Why hasn't it caught on? Of course, like we mentioned, there's a lot of marketing behind some of these higher fund fees. You can do the math that if that RIDEX company that has about 150 million in assets, when they charge a little more than 2%, that's a pretty good fee that they're getting just for running a very basic fund, right? So there's a lot of advertising pushing people into these more active funds. It's also, it's not exciting to be investing in passively managed index funds. It's not going to get you that crowd around you at the golf course. So you have to be okay with, your friends thinking you're boring, I guess. But there is one talking point about how index funds, I think they say, destine you for mediocrity. Index funds are never going to turn your $1,000 into $1 million, and that is pitched as a downside too frequently. And that's a point that definitely deserves some pushback on, because I think it's deceiving. Remember this chart from earlier, this is from that SPIVA report on the vast number of funds that underperform their benchmark over time. And so I would look at this chart and say, hey, if I could have just received the return of the benchmark over that prior 20-year period, I would have outperformed 94 or more than 90% of investors out there. And that's hardly mediocrity. Top decile of investors is pretty darn good. And so that certainly I don't think is a valid point for avoiding these types of investments. And just one more data point, I think this is the final slide here, just to show how investing like this would have historically put you in much better shape than your peers. This is a chart from a JP Morgan research that they put out each quarter, looking at the performance of different types of investments over a 20-year period, in this case from 2001 to 2020. You see lots of investment classes you're familiar with in gray: real estate, different types of stocks and bonds. Then they also overlay a diversified portfolio of 60% stocks and 40% bonds in blue here, and then the performance of what they call the average investor in orange. The data to calculate this average investor return comes from Morningstar. They look at fund flows, so they look at how many new assets have entered into funds, and then if the price of the fund drops and people withdraw money from the funds, they know there was a net loss there by the average investor. And so it is an approximation. It's very true based on numbers as a whole, though. And we can see here that, again, the average investor who might be trading stocks, finding those active funds, is significantly underperforming these very simple, boring types of investments of index funds. And if you think about this time period, it contains many significant events that you would probably think would or could reward those savvy investors that are picking stocks. You have 2001, the tech bubble bursting, 2008 and 9, of course. This ends with the COVID crisis. And as you can see, even with those very notable events, sticking to this boring index portfolio over a 20-year period would have put you, well ahead of average investors. And so not mediocre by any means. And so thank you. I appreciate it. I know this went just a little bit long, but thank you for sitting through this and attending. We hope it was valuable just to see a little bit more detail on the whys of what we do when we're talking with you about your investments and why we manage your portfolio the way we do. And while it might seem boring, there's historically been tremendous value in investing this way. So if you have any questions, please feel free to ask here, or just a follow-up email or phone call is perfect. If there's no questions, thanks again and happy Friday and have a great weekend. Thank you.